Hello and welcome. You ever look at a company, any company, and just wonder, how do people put a price tag on that? How do investors or those folks on Shark Tank figure out what a business is actually worth? Well, today, we're going to pull back the curtain on one of the most powerful tools they use to answer that exact question.
But hey, before we jump in, if you get a kick out of these explainers that kind of make complicated stuff feel simple, do me a quick favor and hit that like button and subscribe. It honestly helps us a ton to keep making more of these for you.
All right, let's get into it. To make this feel real, let's just forget about giant faceless corporations for a minute. I want you to picture your favorite local coffee shop. You know the one. It's got the perfect espresso, the super comfy chairs. Now, if you were going to buy that place, how on earth would you decide on a fair price? That's the big question we're here to answer.
So the very first thing you have to wrap your head around is that a business's value isn't really about what it made last year or the stuff it owns right now. Nope. The real value, the true value, comes from all the cash it's expected to bring in from this day forward. It's all about the future.
Our source material just nails the entire philosophy of valuation in this one amazing sentence. It all boils down to three super intuitive ideas, right? You want more cash, you want it sooner rather than later, and you want it to be as close to a sure thing as possible. Now, that might sound almost too simple, but believe it or not, pretty much every complex financial model out there is just a fancy way of measuring these three things. This is the bedrock we're building on.
So let's actually break that down. We can think of that quote as giving us the three fundamental pillars of value. First, there's the actual cash the business generates. Second, there's the timing of when you get that cash. And third, there's the risk, the uncertainty around it all.
Let's kick things off with pillar number one, cash flow. Now, this is super important. It's not the same as the profit you see on a report. We're talking about something called free cash flow. The easiest way to think about it is this. After our little coffee shop pays for everything, the rent, the beans, the employees, and even after it buys a shiny new espresso machine, the cash that's left over, that's the free cash flow. It's the actual spendable money the owner could literally take home without hurting the business.
Okay, pillar number two, time. This concept is absolutely crucial. $1 in your pocket today is worth more than the promise of getting $1 a year from now. Why? Well, because you could take that dollar today, stick it in the bank, and it would earn interest, right? It would grow. So when we're trying to figure out what our coffee shop is worth, we have to account for the fact that the money it's going to make 5 years from now is worth less to us today than the money it's making this year. And that brings us to our third and final pillar, risk. Let's be honest, predicting the future is, well, it's impossible. Our coffee shop could totally crush it, or a new Starbucks could open up right across the street. A forecast is really just an educated guess. And because of all that uncertainty, $1 that you're guaranteed to get is worth way, way more than $1 that you might get. So we have to penalize those future guesses for being so risky.
So we've got these three big ideas. More cash is better, sooner is better, and more certain is better. The method that actually takes all three of these pillars and squishes them together into one single number, that's called discounted cash flow analysis, or as you'll hear it, DCF.
And the process itself is actually a pretty logical four-step recipe. First, you have to guess. You have to forecast the company's cash flows for the next few years. Second, you pick something called a discount rate. Think of that as just a percentage that rolls up both the time and the risk factors we just talked about. Third, you use that rate to shrink each of those future cash flow numbers back to what they're worth today. And finally, you just add up all those shrunken down values to get your grand total. Now, this is where it gets really cool, seeing it in action. Look at year one. We're predicting our coffee shop will make $50,000. But when we apply our discount rate for time and risk, it's really only worth about $45,500 in today's money. Now look at year three. That $60,000 gets shrunk down even more, all the way to $45,000, just because it's further out in the future. So we add up all these present values, and bam, we get our estimate for what the whole shop is worth today, a little under $136,000. That seems pretty straightforward, doesn't it? But as I'm sure you've already guessed, when you're looking at a huge company instead of a local coffee shop, yeah, it's never quite this simple. The real world loves to throw in some curveballs.
A really big one is debt. Now, debt can actually be a good thing, because the interest a company pays on its loans is usually tax deductible. It's like a little discount from the government, what they call a tax shield. But, as you can see, it's a total double-edged sword. Because more debt also means way more risk. If business slows down, you still have to make those loan payments, no matter what, and that seriously increases the chance of going bankrupt.
A good valuation has to balance both sides of that coin.
And that's why you hear finance people throwing around this alphabet soup of terms. Honestly, they're all just different flavors of DCF, each one built for a specific, more complicated situation. Wake, for example, helps you blend all the different costs of financing. APV is great when a company's debt is changing all the time. You don't need to be an expert on them right now. Just know they're all built on the exact same core idea we've been talking about.
And this really brings us to what I think is the most important point of all. It is so crucial to see DCF not as some magic formula that spits out the one true answer. It's the art of the estimate. It's a powerful framework for thinking. It is not a crystal ball.
This quote from our source material just captures this idea perfectly. It says that the assumption we can actually know future returns is admittedly heroic. I mean, it's a massive leap of faith, right? But it's also indispensable. We have to make these educated guesses. It's the only way to have any kind of logical reason for making an investment.
So here's the bottom line. The final number you get from a DCF is only as good as the assumptions you plugged into it. A tiny little tweak to your growth forecast can completely change the final price tag. The real power of doing this whole exercise isn't the number itself. It's the fact that the process forces you to ask the most important questions. What really makes this business tick? What are the biggest dangers it's facing? How is it actually going to grow?
And this all leads us to this final, really interesting question to chew on. When you strip away all the math, is valuing a company a perfect, objective science, or is it more of a professional art? A blend of numbers, yes, but also judgment, intuition, and a deep understanding of the story behind the business. It's a question every single investor has to answer for themselves. Thanks so much for diving in with us today.